All right, welcome to the conversation about generating cash flow in retirement. Now, I got to give a lot of credit to my father on this one. He created this conversation about 20 years ago. And since then, you've seen all sorts of people talk about this. It's been written about in books. Now, it's one of those things where, he created it on his own, and there's probably a number of other people that created it at the same time. But the conversation is getting much more popular, and that is this. Remember Stephen Covey? He wrote the book, 7 Habits of Highly Effective People. One of those habits was begin with the end in mind. And if I know I want to save for retirement, shouldn't we talk about how much money my accounts can generate in retirement years? So instead of just saving money for an event, why don't we talk about, if I get what I want, what does that spend like throughout retirement? Okay? So I call this the 3 buckets. In the 3 buckets, let's fast forward you to retirement age, and you're age 62. And at age 62, you qualify for Social Security. Now, if you look at your paycheck right now, you've paid into Social Security your entire working career. And most people believe that that's going to be a tax-free benefit in retirement, right? You're entitled to that money back. Wrong. Depending on where you keep your money will determine if you're actually going to be able to keep all of your Social Security or not. So, in the 3 buckets, the first bucket, let's call it always taxed. So bucket number 1, always taxed. Bucket number 2, sometimes taxed. And bucket number 3 is never taxed. Now there's all sorts of different types of assets that we can own over our career. But when it comes to the IRS, really there's about 3 different ways to tax you. From all the different asset types that you own, it's going to fall into one of 3, usually one of 3 different categories. Always taxed, sometimes taxed, or never taxed. Let me give you another example. Bucket number 1 is considered ordinary income. Ordinary income is always going to be taxed. Sometimes taxed would be after-tax investments or non-qualified investments. Sometimes real estate can fall into this category. Real estate's kind of interesting. It falls between the 2, though. It can sometimes be taxed as ordinary income and sometimes taxed as bucket number 2. Then there's never taxed. And never taxed is considered tax-free or tax-exempt. Okay, there's a couple different examples. The first one I'm sure you've heard of is a Roth IRA. Roth IRAs are so great, they actually limit how much you can put in. And if you make over a certain amount of income, they limit if you can put in at all. So a Roth IRA is never taxed. Debt is never taxed. Now think about this really quick. If I wanted to go buy a house, I could go to the bank and borrow $500,000. Go buy my house. Do I owe any tax on that $500,000 that comes to me? No. It's debt. I owe the $500,000 back, so the debt comes to me tax-free. You want to know who understands this? Donald Trump. Do you think Donald Trump has ever paid for one of the buildings that he's built in New York City or Chicago? No. He uses other people's money because it comes to him tax-free. But then he charges rent in those buildings, and when people pay rent, who do they make the checks out to? Donald Trump. So, other people's money, which we've talked about in all these courses prior, other people's money allows me to get money tax-free. The problem is I have to pay it back. Another way to get tax-free money is life insurance. Now, most people don't understand how life insurance actually works, and rightfully so. There is tons of products out there, and they're often misrepresented. But there's a ton of different types of products. Life insurance is a benefit that's set up to pay your heirs if something happens to you if you die. But inside the tax code, there's actually some benefits. A policy can be designed so that you grow cash value inside. And inside the cash value, as that grows, I actually can access that tax exempt. So let's look at, depending on where I keep my money, what's the real value? Okay? Let's assume you have $1 million in each one of these buckets. This is where the engineers are going to have fun. Ready? The dollar amount is exactly the same in each one of these buckets. The value is totally different. You want proof? Take it out. Take out the $1 million. Let's assume you're age 62. If you took out $1 million from your as income, let me give you an example. Your 401k or an IRA, any sort of pre-tax retirement account is going to be bucket 1. So if you took $1 million out of your IRA at age 62, you're going to owe a federal income tax at right now as high as 40%. Depending on where you live, you might owe a state income tax. There might even be a local income tax. I'm from Michigan. If you live in a few cities in Michigan, they're going to charge you extra just because you decided to live in their town. So as you take distributions in retirement, they get a portion. Your Medicare costs go up. And you've heard the government talk about how Medicare is going to be free. Medicare is never free. We paid for it our entire lives. And if you show income in retirement, you might even have to pay more. And finally, Social Security. The Social Security that you're entitled to can become taxable. That's right. Up to 85% of the Social Security that you're entitled to can be taxable as income in retirement years. When would you want to figure out how much of your Social Security you're going to keep? Today or when you go to retire? Now let's look at bucket 2. Now let's look at bucket 2. Bucket 2 is sometimes taxed. This is considered growth. Okay, so I invest in after-tax money, and as the account grows and as I sell, I will owe tax sometimes when I realize that gain. But it doesn't get taxed as an ordinary income. It gets taxed as a capital gains tax. And historically speaking, the capital gains tax has been much less than the income tax. Right now it's around 20%. 23% when you add in the Obamacare. So ask yourself, which tax would you rather pay? Bucket 1 or bucket 2? Yet where are we taught we're supposed to keep all of our wealth? Bucket 1 is pretty popular, isn't it? How many times have you heard at your workplace that you need to max out your 401k or max out your 403b? Let me tell you why I think that is. I believe that the industry is incentivized, the financial industry is incentivized to teach the consumer to save in a pre-taxed account. Why? It's very easy to understand. If I'm charging you a fee to manage your account, I want that account to be as big as possible, right? Well, what better way to increase that account than to use the IRS's money to inflate the account value? I would love to charge you a fee on pre-tax dollars because a portion of your account has to go to the government. The government doesn't pay the fee, you do. The government doesn't help share in the risk, you take on the risk. But when you go spend your money, the government's the first one to get paid through federal tax, state tax, local tax, Medicare tax, Social Security. All of these income-based taxes are only going to be paid if you allow them to be. Depending on where you want to keep your money, you can avoid those taxes in retirement. So, as an advisor, this is why advisors love your 401k probably more than you do. They get paid on that thing every single year, and you're taught how to watch it and hope you live to age 60 and be able to retire. Now let's look at bucket number 3. Let's say I have $1 million in bucket number 3, and let's say I have $1 million in cash value life insurance, and I took all of it out. How much tax do I owe? 0. In fact, there's no 1099, which means it's non-reportable. Which means no one knows it exists. Which means, depending on where you live, it's protected from lawsuits. Which means it doesn't offset your ability for your kids to get a loan in college. Which means you can have access to this off the radar screen of the IRS for income tax purposes and capital gains purposes. There's neither of those taxes due. So think about this. We've already talked a little bit about life insurance, but because bucket 1 is invested in the market does what? It goes up and down. It doesn't compound because there's losses. Because it goes up and down, there's an idea called, and you can look this up, it's called safe money withdrawal rates. And that is, the meaning of that is this. Let's say I get to age 62 and I have $1 million inside of an account. The account goes up and down. So how much of the account can I take out and not expect to run out of money by the time I die 30 years later? So life expectancy plus a couple years, age 92. So I have $1 million in an account, which is a lot of money. But because the market goes up and down, I have to figure out how much I can take out in good years and in bad years. And the safe money withdrawal rate will tell you Throughout the 90s, it was like 7%, meaning you got $1 million in an account, you can pull out around $70,000 a year. Then 2001 happened, so it went down. There was what's called the 4% rule. And for a long time, you had $1 million in an account, the $1 million would generate around $40,000 of income for you. But then 2008 happened, so it went down even more. Right now, you're looking at right around 2.8 to 3%. What does that mean? You have $1 million in an account, which is a lot of money. But what it can do for you in retirement, if you don't want to run out of money, they tell you, the experts tell you, not to take out more than $28,000 to $30,000 a year in retirement. Taxable if it's inside the 401k. $30,000 a year taxable. Now, bucket number 2, again, it's usually invested in volatile stuff, whether it's real estate, whether it's after-tax investments, it goes up and down. There's no compounding. Same thing. You can pull out anywhere from 3, depending on the asset, maybe 4 or 5%. So what does that mean? Your $1 million can give you $30,000 to $50,000 a year taxable. And both of these only have a 95% success rate, meaning there's still 5% of the time that odds are you're going to run out of money before you die. Let's look at life insurance. We've already talked about how life insurance compounds forever. And if I access it correctly, I won't stop that forward momentum or the future compounding. And because my death benefit is posted as collateral that's guaranteed to pay off the money that I borrow, I can then borrow against the future growth and the future benefit to my heirs and never pay an income tax. And because it's continuing to grow as if I had never touched it, my distribution rate goes to around 6 to 7%. What does that mean? You can take $60,000 to $70,000 a year out, tax exempt, and still have the 95% chance of making it. Now you tell me, which bucket would you rather have? $30,000 a year taxable, maybe $50,000 a year taxable, or $60,000 a year tax exempt? Let me put this a different way. In order to duplicate what life insurance can do for you, if it's properly structured, in order to duplicate the after-tax cash flow that life insurance can give you, you would need 2 to 3 times as much inside bucket number 2. So you would need $2 to $3 million inside bucket number 2, take the distribution, pay all the taxes that are going to be due, and net the same number that life insurance could have given you. 401ks, think about this. You're going to have 4 to 5 times as much money in a 401k to duplicate the after-tax cash flow that life insurance can give you. If you have $1 million in cash value, that will net you around the same amount of money that a $4 to $5 million 401k can net you. Now, this is obviously just blanket statements, and everyone's going to be different. Okay, so individual circumstances will vary. However, if you go to the course that talks about how to retire off the radar screen of the IRS, I will teach you how to calculate how much money you would need to have to duplicate that cash flow. Now, as a little side note, think about this. If you were an advisor, what would you rather manage? A life insurance contract that doesn't pay fees, that the advisor gets only a limited commission on? Or a 401k or an IRA that has pre-tax dollars where they constantly teach you have to have so much money in there in order to succeed in retirement? The income for the advisor goes up in bucket 1, usually. All right, check out the bonus chapters on how to use life insurance before retirement and through retirement. It'll have a lot to do with this conversation. Okay, hopefully this gave you a little bit of insight as to how these assets can pay you throughout retirement. So don't forget to go to the next courses on how to use life insurance before retirement and through retirement. And also there's still some questions at the end of this, so don't forget to answer those questions. Enjoy.